Cryptocurrencies have taken the world by storm, and for good reason. They're decentralized, anonymous, and untraceable. However, this anonymity comes at a price. You can't simply go to your bank to get money out of an account holding cryptocurrency. Instead, you must purchase it from an exchange or broker first. Cryptocurrency investing isn't as easy as just buying a few coins and calling it a day. You need to do extensive research, properly assess risk levels, and make sure that your money is well invested. In this video we will discuss some of the basics of investing in cryptocurrencies. We will give you some insights into possible investment opportunities, pitfalls to avoid, things you need to keep in mind while investing in cryptocurrencies, and how much should you invest at any given time. What is cryptocurrency? Cryptocurrency is a digital asset that uses blockchain technology to facilitate secure financial transactions. While the term is sometimes used interchangeably with digital currency is only one application of blockchain technology. Cryptocurrency is a subset of the broader digital currency category. Digital currency is a currency that is issued and stored electronically. Cryptocurrency is a subset of digital currency that uses cryptography to secure the transaction process, thereby making electronic transfers secure and anonymous. How to invest in cryptocurrencies? There are a couple of different ways to invest in cryptocurrencies. The first is to use an exchange like Coinbase or Gemini. The second is by buying a pre-existing token like a stock. Coinbase is a popular US-based exchange that allows users to buy and sell cryptocurrencies, and transfer between exchanges. Coinbase also has a very good beginner's guide to help you get started. There are also a number of different BTC, ETH, etc. based hedge funds that invest exclusively in tokens and coins. These are more expensive than using a regular exchange, but offer greater security and are less likely to go bust than a regular fund because they only buy high-risk tokens that have a very high potential for gains. Bitcoin, Ethereum, and other altcoins. One of the most important things when it comes to investing in cryptocurrencies is to first understand the difference between Bitcoin, Ethereum, and other altcoins. Bitcoin is arguably the most famous cryptocurrency and is also the oldest. It was the first to be created and is currently the most valuable cryptocurrency. Bitcoin is a payment system, while a cryptocurrency and a store of value, i.e. money, at the same time. The reason why it's so valuable is that, unlike other cryptocurrencies, it's the only one that's actually used by millions of people all over the world. For example, a pizza shop in New York might accept Bitcoin as a payment method. Bitcoin has high volatility because it's a brand new market, so it's very risky to invest in. At the same time, it's also very lucrative if you're able to get in at the bottom. Another important thing to note is that there are many altcoins that are simply Bitcoin clones. Most of these have very little value, are nearly always down in price, and are not actually used for anything. Risk assessment. Which coin should you buy? With so many new cryptocurrencies entering the market every day, how do you choose which ones to invest in? Before you even think about investing in a certain coin, you need to understand the risks associated with it. This risk assessment process is crucial to avoiding massive losses and is also very important when it comes to deciding what coin to invest in. There are a few key factors to consider when assessing risk. Is it a new token? New tokens are risky and extremely risky. Investing in a new token is extremely risky because no one actually knows how successful it will be. New tokens are basically gambles on new blockchain technologies. In most cases, the token will lose all its value within a very short time, as there's no way of knowing if the technology will hold up. Is it a profitable investment? Profitable investments are usually much more stable than risky investments. However, you still need to be very careful because your money could still go bust if the investment does not prove profitable. How much is it worth? The price of the investment is one of the most important factors when assessing risk. It's important to note that the price could go down as well as up, so you could lose money slowly as well as quickly. Tips for newbie investors. Get a wallet. A cryptocurrency wallet is a sort of virtual bank account that holds your coins. You need to store your coins in a safe place, otherwise you will not be able to withdraw them when you want to sell your tokens. A good place to start is Coinbase, as it's one of the most popular wallets around. Don't invest everything you have. You should never invest all of your money in one single project. It's important to have a balanced portfolio of different investments. Don't invest what you can't afford to lose. You should never invest money that you can't afford to lose. Otherwise you might as well put it in the bank. Research thoroughly. Before you invest in any project, make sure you do extensive research, as this will help you find the best projects and avoid wasting your money on risky investments. Be patient. While investing in cryptocurrencies can be very rewarding, it's important to remember that it can take a very long time to make a profit, so you will have to be patient and wait for the returns over a longer period of time. Conclusion. Cryptocurrencies promise a lot, and they're here to stay, but they are extremely risky and could end up losing a lot of money for a lot of people. If you're lucky enough to have some money to invest, now is a great time to get into the market. However, you should be very careful and only invest what you can afford to lose.